How do you keep investing when you feel the market is expensive? Because of this big run up, stocks are kind of expensive to their earnings.
Yeah, uh, it can get a lot more expensive. I actually don't put a lot of emphasis in the PE ratio. I've just learned over the years, the PE ratio, oh, that looks really cheap. It can get a lot cheaper,
Hmm.
a lot cheaper. In that downturn in 2008, that unwound over what, about a year and a half period, and the PE just kept getting lower and lower, and so you were trying to basically catch a falling knife if you were trying to buy that. The opposite can go the other way. 1995, I kept hearing how expensive it was, and man, if you'd have bought in 1995 and managed that money well, by the end of the run there in end of 99, you'd have made some awesome money.
Yeah.
So I really, I don't really look at it that way because it hasn't panned out. I mean, if you look at it very long term, and you're willing to be a 30, 40-year investor, you can make some arguments for, just accumulating under certain PE ratios. If it gets under 13, you just accumulate. It might go
Mhm.
to 10 or 9, but whatever. But the problem is that, first of all, in the investing world that we're in, clients give us maybe 3 months, not 30 years.
Mhm.
And so there's got to be some performance results that are coming out on a fairly regular basis. So it depends on your tolerance for time. But uh, I think personally, dollar cost averaging is always a decent concept in my world. But be careful. I'm more concerned about the stretch of the market,
Mhm.
the relative strength indicator, the
Yep.
Wilder's relative strength indicator on a 7-day basis. When that gets above 70, I get nervous about putting new money in. And we'll often hold off when new money comes in until it gets below 70, and then we'll start accumulating. We did that just, at the end of last year. As
Yeah.
I recall, it worked out okay. Um, and it's above 70 right now. I think it's 72.6 or something like that. So definitely a little stretched out. However, this is a weird scenario. I'm telling you, this could stretch out and stretch out and stretch out. You could be sitting there waiting for it to get below 70 for quite a while and really miss out on a pretty good run.
Yeah.
I mean, we went back today because we had this question already. It got to a little over 80, I think
Yeah.
82.
In December, right?
Yeah, December 19th, right? And so you would say, oh, that's just too high. I wouldn't buy there. And we didn't actually. We waited till it got below, and it did,
Yeah. A slight pullback.
Yeah, a slight pullback, and we bought, and that worked out better than buying it at 80. But if you'd bought it at 80, you'd be really happy right now.
You'd still be good.
Yeah, you'd still be up a lot. So sometimes certain markets get such heavy, heavy momentum to the upside. You need to ride that. Even if you're wrong and it pulls back, okay, great. But you might be right. And these types of opportunities don't come along that often. So I wouldn't be too nervous about this market the way it's sitting right now because the momentum is so good. And because there's some fundamental reasons why this market's moving. It's not just, some crazy thing. The Federal Reserve has stopped raising rates and is now actually talking about lowering rates versus, just hammering the market
Yep.
verbally, for the last, almost 2 years. So, I think that there's some catch up to do here. The market probably shouldn't have even come down. If you look at, I mean, there wasn't a recession. Why is the market coming down in 2022? It shouldn't have. And I think that's the realization now, especially if we have this no landing scenario that they're
Yep.
talking about, that, hey, the market should be higher already. Because if you look at the normal trajectory going back, say 20 years and draw a line on there, we've got to catch up to that trajectory. Uh, so anyway, that's it's a good question.